Hey, you guys, it's Jennifer Reynolds. We are going to talk in this chapter about selling goods rather than services. So, a product like maybe these cups in my hand. And we're also going to talk about the relationship between accounts receivables and that revenue. So, when we sell goods on account and don't collect the money right away. So, I have four different new types of things we're going to learn in this chapter on the board behind me. I'm going to give you an example of each of these. A company might offer a trade discount, and we sometimes call these quantity discounts to entice customers to buy more from them. So, say I'm a company that wanted to buy a bunch of cups and put my name and logo on it. The company that's selling these cups may say, okay, these cups cost $1.20 each. But if you'll buy 100 of them, we'll give them to you for $1 each. And if you'll buy 1,000 of them, we'll give them to you for 70 cents each. So a quantity discount, okay? Then we have sales returns. What if I'm the company that purchased these cups from the manufacturer, the company that made the cups and printed the names, and I got them all and they had all the wrong names or the wrong logo on them? Then as a customer, I might take them back to that company and say, I don't want these anymore. And the customer would have to one of two things: give me my money back. But if I haven't paid for them yet, if I bought them on account, then the company would reduce their accounts receivable to say, aha, Jennifer, this customer no longer owes us this money, right? So those are sales returns. Sales allowances could be, what if the logo was just slightly off? The green wasn't quite as green as it normally is. And the company said, okay, tell you what, customer, if you'll keep those, we'll give you 20% off. And I go, okay, I can live with that. The green's just a little bit off. Sure. So a sales allowance is another form of a discount. When maybe a customer's just not super happy with a product for some reason. And then finally, we have sales discounts. We sometimes refer to these as cash discounts, but these are an enticement to get the customer to pay faster. And there's a format you need to learn that goes along with sales discounts. Let me give you one example. This can be written, oops, I wanted that to say 45. The seller of the products can create any kind of terms, but there's always a format that it goes in. And this first number means the percentage of discount. And this second number means if it's paid within this number of days. And then it says if not, the net balance is due in 45 days. So what that would mean is if I offered this to sale to a customer, I would tell them, look, you've got 45 days to pay me back. No problem. Those are our normal accounts receivables terms. But if you pay me back within 15 days, I'll give you a 3% discount. Why would a company do that? Well, companies have cash flow problems too, or just cash flow issues. Cash flows are one of the most important things a company needs to pay attention to. If you run out of cash, you can't do business. So, okay, keep those four things in mind. I'm going to give you four examples, but one thing to pay attention to as we go through these is that one of these things is not like the other. Trade discounts are going to act differently. If a company offers a trade discount, the company just records the revenue at whatever the discounted price is. Whereas if a company offers any of these, they're going to record the gross amount of the revenue, and then they'll back out that revenue. Instead of debiting the revenue account directly, they're going to do it through these contra revenue accounts. Y'all know what that word contra means. It acts the opposite of, like if you're being contrary and your mother tells you that, you're just being the opposite of how I want you to be. So that's what a contra account is. And then if you can remember your dealer chart, when we increase revenues, we make a credit entry, right? Because it's over there on the right side. So if a customer brings back a bunch of things to us, we would want to debit revenue. But again, instead of debiting the actual revenue account, we are going to create these contra revenue accounts. Why would that be? Well, so that a company can analyze what's going on a little better. Managers at the end of the year or the end of the month need to look and see how many returns. Why are people bringing back this one pair of glasses? Maybe there's a defect in them. Maybe this shirt that we ordered and we're trying to sell is really ugly and we don't need to order that anymore. Helps managers analyze returns, discounts they're giving, and things like that. Okay, so let's do some examples. Okay, I know this looks like a lot of writing on the board, but it's not. Bear with me. We've got a few transactions here by a company called Sparkle Company. Sparkle Company sells cups to customers who are, for whatever reason, are gonna use them or resell them or whatever for $1.20 each. But if the company buys 100 or more, the price is only $1. So here's some sequence of events. On June 1st, Sparkle sold 500 cups on account. Remember when you see those words on account, underline it, circle it, and you go, no cash happened. Sold them on account for terms 210 net 30. What did we just talk about that means? That means if this company pays them back within 10 days, they're going to get a 2% discount. If not, they've got 30 days to just pay the full balance. What would Sparkle record on June 1st? They sold some stuff. 500 cups times $1.20? No, this is a trade discount. So we just recorded it whatever the discounted price is, which is only $1. So we're going to record sales revenue of 500 times $1 a cup, $500. Sales revenue, 500 bucks. What am I going to do for my debit here? Not cash, because remember, we sold them on account. So if I'm Sparkle, my accounts receivable goes up by $500. I've got some T accounts because this is how you're going to see this and remember this and talk about where they're going to show up on the financial statements at the end. So I'm going to post each transaction as we go. My AR, I have a debit of 500. I'm going to put check there so I remember that I posted it. My sales revenue, I have a credit of 500. Both of those are increasing. This is an asset, so it increases on the left. This is a revenue, so it increases on the right. Okay, now we go to June 2nd. The customer returns 100 of the cups. Hey, I didn't need these. I don't want these. I'm bringing these back. Here you go. What does Sparkle do? Well, if revenue increased when they sold the cups, now that a customer is bringing them back, revenue needs to decrease, which we know needs to be a debit. But remember, we learned, oh, we are not going to debit sales revenue directly. We're going to use that contra revenue account called what? Sales returns. Just like it sounds, it's a return. Okay, how much would that be? Well, it was just 100 of the cups, right here. So $100, because remember they bought them for $1 a cup. What is the credit that Sparkle Company is going to record here? Picture, you own a store, customer brings you some cups back. What do I hand the customer? Well, it depends on how the customer paid. If they paid with cash up here, I'm going to give them the cash back. But look, y'all, these people haven't even paid me yet. So I'm not going to give them the cash back. It's not theirs. They didn't pay for it. What I'm going to do is reduce this AR account and say, ah, now you owe me $100 less. So let's post this, $100 to our sales return account, debit, and $100 credit to our AR. Ah, that makes sense. This customer owes us 500. Now they owe us 100 less because they brought the cups back. All right. The third one says, now Sparkle gives the customer an allowance of $20 for a defect. So that would be that example where I said the customer goes, this blue's not exactly right, the green's not exactly right. And Sparkle says, oh, I don't really want to have to return those to you. Will you just keep them if we'll give you a $20 discount? And the customer goes, yeah, okay, I will. What does Sparkle record? Well, once again, their revenue is going to go down by $20. But instead of debiting the revenue account directly, they debit another contra revenue called sales allowance. For the 20 bucks, what would the credit be? Again, Credit's going to make the AR go down because this customer has not given them any cash yet. So let's post these. We did that already. Sales allowance, debit of 20, AR, credit of 20. You're about to see why this is so important to use your T accounts. Final transaction over here. Yay, it's June 9th. The customer pays us. How much does this customer owe Sparkle? Got a couple of things to consider. Remember up here where it said Sparkle sold them with terms of 210 net 30? We didn't take into account that discount because we didn't know if the customer was going to pay us back on time or not. Now we know the customer has paid within the discount window. Sold on June 1st, paid on June 9th. That's within the 10 days. The customer is going to get how much of a discount? 2% if they paid back in 10 days. 2% of what? That's where our T count comes in handy. 2% of what is owed at this point, not 2% of 500, because the customer brought some of the cups back and the customer already got a $20 discount. So only 2% of what is owed here. Can you quickly look at that and tell me what the customer owes Sparkle? It went up by 500, down by 100, so that'd be 400, down by another 20, $380 is the customer's balance. That is what they get a discount on. So $380 times 2% is a $7.60 discount. So now can you figure out how much the customer owes Sparkle? They owed $380. They're going to get a $7.60 discount. So the customer only owes $372.40. We're Sparkle. That's what we're making the journal entries for. What would Sparkle record? Well, cash of what we just talked about, $372.40. Here's what can be the tricky part for some students. You go, okay, what's the rest of this transaction? Why, if I'm Sparkle, why did I just get this cash? I didn't sell anything new, so I'm not going to record more sales revenue. I got this cash because the customer was paying off their AR balance. You go, oh, okay, cool. AR of $372.40. What? Don't stop there. That's not right. Why? Look what happens if I were to post this $372.40 entry in the AR account. What balance would be left? $7.60, right? 380 minus 372.40 is our 760. Does the customer owe that 760? No, Sparkle told them, even Steven, man, if you pay us within 10 days, you don't have to give us the rest of it. Even though you owed us 380, we'll take 372.40 and call it good. So Sparkle needs to record something right here that is going to let them end up, there's my eraser, with a zero balance. Let me move these sales returns down. Sales returns of 100. Okay, so Sparkle, instead of that, needs to make an entry that shows zero balance. This customer does not owe us anything else. Therefore, they have to make an entry for $380. So I'm going to come down here and erase that and say 380. But Jennifer, I know that debits have to equal credits. I cannot leave that journal entry like that. If I've got 380 on the right, I need to add up to 380 on the left. So I need another $7.60 debit here. What account is that going to be? That's that contra revenue called sales discounts. Okay, let's look at this all together. I already posted the AR of 380. I don't have a cash T account up there, but we're not focusing on that, so I'll leave that off. Let's post these sales discounts of $7.60 debit and figure out where all this is going to go on our financial statements. Well, AR is an asset, so it goes over on our balance sheet. At this point, 380 minus 380 is zero. If this were our only customer and the only transaction, Sparkle would record nothing. Customers don't owe us anything at present time for AR. The rest of this stuff, revenue related, goes on our income statement. I have our basic net income formula, revenues minus expenses equal net income. And you go, well, all of these new accounts seemed to reduce revenues. So are they an expense? What type of account did we say they were? They are a contra revenue. So yeah, they reduce revenues like expenses do, but they're not an expense. They go up here underneath your revenues. So let's just report all this and see what it would look like. I would have $500 in revenues, and then I would have sales returns. So minus, I'm going to say SR, and y'all are going to know what that is. Minus 100 of sales returns, minus 20 of sales allowances, minus $7.60 of sales discounts. Eraser again, please. Thank you. Got it. Erase this to give myself some room. And we have another new term, tons of new terms in this chapter. We are going to call this net revenues. So our net revenues minus are 400 minus the 20, 380 minus the $7.60, 372.40. Let's talk about some things real quick. Is that the same as net income? No. Why? Because we haven't taken out all of our expenses yet. We still have salaries, rent, utilities, all those operating expenses. So these three things are a contra revenue account. They get reported on the income statement right underneath gross revenues. And remember the words gross and net in accounting. Net just means it's been reduced by something. So gross revenues minus the contra revenue accounts equal net revenues, then minus expenses, and we'll get down to net income. And a little later, we're going to have some net AR over here. So don't let all these new nets confuse you. Net just means it's been reduced by something, but it could refer to lots of different things. Your net paycheck, your net revenues, your net ARs, all of that. So what else do I want to say? Last thing, I think we're going to come up with a lot of different types of contra accounts. Contra accounts always have to go with a buddy. They cannot exist without a buddy. If there were no sales revenues, there would be no sales returns, allowances, or discounts. So when you're trying to figure out the type of contra account it is, contra revenues in this case, it's just whatever its buddy is, whatever the account it reduces. In this case, revenue. So these are contra revenue accounts. We have contra asset accounts. We have contra equity accounts. And you remember all that by just saying, well, what type of account does it reduce? If it reduces a revenue, it's a contra revenue account. And they are always going to go on the financial statement with its buddy and reduce it. So you notice how we subtracted all of these contra revenues from our gross revenue there. And those are all of your new contra revenue accounts.